Welcome to Money Market, a Bank of Tampa podcast. We highlight the businesses, expert business advice, the local economy, and points of interest in the Tampa Bay market. You can find us on Apple, Spotify, YouTube, or wherever you find your favorite podcasts. So if that's something of interest to you, hit subscribe. We're quickly gaining some steam here in the Tampa Bay market. I am your host, Owen Lefebvre, the Pinellas County Market President for the Bank of Tampa, Tampa Bay's oldest and largest community bank. Today we are joined with a very special guest, the Director of Commercial Real Estate for the Bank of Tampa, Rachael Brown, to talk about the commercial real estate market, the lending environment, banks. There's a lot going on with banks. Rachael started working in commercial real estate in high school, working with her father, who was a developer in Southwest Florida, an intern for DRA Advisors, a value-added real estate investment fund manager based in New York City. She graduated from the University of Miami, the U, where she majored in finance and business management with a minor in real estate law. And for some reason, I forget that part, but I want the turnover chain to come back.
I want the team to come back. So I'll take the team first.
Can't they go hand in hand? So for those that don't know, they used to have this big gold chain they would give to someone when they had a turnover. Did Uncle Luke buy that thing?
Yeah, it was very Miami. But when the play doesn't match the swag, it's really not appropriate.
It's got to go away.
Yeah.
So you graduated in the recession and the great financial crisis, and so you began your career in commercial real estate workout, also referred to as special assets, at Wells Fargo. So basically working on distressed or bad loans, and we hope that you don't need that skill anytime soon. And I did that tour of duty also, but we'll talk about distressed commercial real estate. So as the economy improved, Rachael moved into lending with experience in both general commercial real estate and multifamily agency lending. She joined us at the Bank of Tampa as our Director of Commercial Real Estate Banking. You are on the board of the Society of Real Estate Professionals, or SOREP, and the advisory board of the Real Estate Society at University of South Florida. So with all that, Rachael, welcome to Money Market.
Thank you for having me.
Quickly for our listeners, just to touch on, what is your day-to-day? Because as commercial real estate director for the bank, and my previous job, people would call me primarily site brokers and think that I was looking for the next Bank of Tampa location. But what is your actual responsibilities for the bank?
Yeah, so my job is to basically monitor the market and handle all of our investment commercial real estate for investors and developers. And it's important to know where we want to be in the market, who we want to lend to, and basically helping not only my team, but the rest of the bank manage that. Okay.
So on the lending side, you're really tied into not only what the bank is doing, but what the competition is doing in the marketplace. And a lot of noise around that. I feel like every time I open the Wall Street Journal or LinkedIn or X, we talk about the doom and gloom of the commercial real estate market and its demise, and it's going to take down all banks.
Yeah, of course. Absolutely. That's exactly what's going to happen. No, it's a weird time to be in banking and in commercial real estate because you feel like there's a lot more attention than there has been pretty much ever in banking, and then with commercial real estate, more attention than there's been since the great financial crisis. So I do get a lot of questions from a lot of different people trying to understand what's going on. I feel like the news really likes its headlines, but doesn't really get into the nuance of it. So while people are paying attention and reading the headlines, it's really hard to get the true story unless you're really diving into it and pretty much working in the industry.
Well, I want to talk a little bit about the true story, because even commercial real estate professionals that are involved, there is just someone to be nameless, pretty prominent real estate name in New York City that was talking about 500 banks that are going to fail as a result of the commercial real estate credit issue that is forthcoming. I mean, there's $2.2 trillion is the debt wall that's coming between now and in 2028. We expected a lot to happen last year, and as it turned out, I think there's $570 billion that was maturing. The 270, I think maybe in that range, had been deferred. So now we're up to 900 billion. That's floating out there, maybe extend and pretend, but we're not really seeing any huge credit issues yet.
No, and it's a lot different here as well. So it really depends on what markets you're talking about. There is definitely a lot of nuance there as well. My concern is just what kind of overall effect, trickle-down effect will it have if you're having a lot of issues in, say, a Chicago and a New York and a California to the overall market. affecting us down here as well. When you look at the metrics across the board and across product types, Tampa really is kind of in the middle of the road. And in terms of office, we're actually doing better than most markets. So, a lot of times we'll see articles down here about how expensive Tampa's getting, about how, multifamily is not leasing up, rates are dropping, industrial buildings are going vacant. But then when you look at the actual metrics across the board, we really are pretty much middle of the road when it comes to most every category. And in terms of markets where there's the most concern, definitely markets that we compete with, like the Austins, Atlantas, Charlotte, Nashville, they're having a lot more issues than most of the Florida markets. So I do think there's going to be more pain to come. You have to, right? If nothing's transacting, we're down 50 to 70% transaction volume in 2023. You're really not seeing the change in values reflective of where we are in the market yet. So that hasn't shaken out. And then there's these maturities that are coming up, like you mentioned, that you can only extend and pretend for so long. And then is the owner going to give up on it, or are they going to continue to try to put money into it to maintain it? I don't think, if you have a obsolete office building in San Francisco, you're going to want to keep throwing money into that. So again, what's the trickle down going to look like in Florida when you're having issues like this outside?
Well, a lot of it, it is real estate's local, right? So location, and product type, which we've seen, not only locally, but around the country, varies dramatically. So as it impacts banks in particular, I think what's also important, what gets lost is, regional banks, community banks do have a larger percentage of commercial real estate as a percentage of their overall loan portfolio. And that's real. When the market kind of rebounded after the Great Recession, it was regional banks and community banks that kind of led the way. The larger banks, I think, were a little more measured, and they're just larger, right? So if you're a smaller bank and you do a very large commercial real estate loan, all of a sudden your exposure is a lot higher as a percentage. But looking at the actual composition of what those banks' balance sheets look like, if you're in San Francisco or Chicago or New York, for that matter, where office is really challenged, you're going to have a harder time than you are in Tampa, where the office market is I won't say thriving, but is doing pretty well.
Yeah, we're still sub 10% vacancy rates, which is really normal for an office market. So, yeah, I think a lot of those cities that you mentioned are not fixing a lot of their quality of life issues either. And so from a competitive standpoint, we still look very good. My gut feeling is if rates decrease again, you'll see another flow of people moving down here because they feel like they can buy a house at a better interest rate. So I don't know how that's going to shake out, but I kind of feel like in the long run, Tampa's still going to continue this trajectory, albeit not as fast as it was during COVID. COVID really sped up a lot of different things all at once, and we're basically just living through it right now, right? Everyone traveled to Florida during COVID when they couldn't go anywhere else. Now travel is slowing down in Florida because everyone just took that trip. So, is that a sign
of... we're supposed to have record spring break numbers.
Right. Well, now that South Florida doesn't want spring breakers, I think we're getting a flood of that too.
Come to Tampa Bay.
Yeah. I don't think that is a sign of a decreased interest in the long term for the Tampa Bay market or the Florida market for travel, but, we're having to kind of live through that slight slowdown in travel or, homes selling. We can't keep up the pace of home sales that we had through 2021, 2022, and I don't think we should. I don't think it's a good thing for the health of the market.
No, and candidly, we don't have any home sales and we just don't have any inventory and we can't build quick enough. And we're talking about interest rates too and the impact on that. But I have an extremely low interest rate, and so I'm not selling. And I think a lot of people in that are homeowners, which is effectively 65% of the country, they're in that similar position. Right. And when you look at the Treasury rate has been all over the place. If we do get a little relief there. Not sure much how the Federal Reserve is going to have an impact on that, but at least in terms of Treasury and mortgage rates,
right,
that will have a huge impact on freeing up some inventory in the market.
Yeah, and the Fed has made it clear that the CRE market is a small blip of what they're looking at. We are a small percentage, so when they make decisions, they know there's going to be winners and losers. their main focus right now is inflation. So if those inflation numbers aren't 2%, they're going to continue to keep rates high. So even though, we may be complaining and feeling the pain and thinking, oh my God, how are they keeping these rates so high? Again, we're just a very small component to it. So don't expect rates to go down if inflation maintains.
Yeah, so we're not going to get our 6 rate cuts, is what you're saying.
I don't think so, unless something happens in the market where the inflation deflates.
Yeah, no, the market's calling for maybe a 25% basis point decrease in June, but I don't know it. I mean, when you look at inflation, CPE and PCE or CPI and PCE are trending in the right direction. PCE, which of course the Fed likes to look at, was at 2.4 annualized. So moving in the right direction. And Chairman Powell will tell you that they don't necessarily have to get down to 2%, but as long as we're consistently moving in the right direction, maybe there's an opportunity to reduce interest rates, and that would be a relief to commercial real estate as well as banks' balance sheet and AOCI losses. Yeah,
I mean, perhaps if there's a big issue in the banking industry, that might come into play as well. The election might come into play as well. Rafael Bostic spoke a couple weeks ago in front of a commercial real estate group, and he basically said, though, 2%, he's like, if we don't stick to 2%, then we lost all credibility. I don't know if I agree with that. So we'll see if how serious they are about that and if they're going to overshoot.
Well, so I think in this stage it would be nice. We want to see rates come down because we did it. Mission accomplished. We're landing the plane versus we have some sort of economic event that triggered the need to reduce interest rates.
That's the hope. I mean, ideally, we'd hit 2%. There'd be no recession. They'd lower the rates. Everything kind of goes back to normal, and then we live happily ever after. There's a chance of that happening. I'd love to see it.
Yeah, well, the only time we ever had a soft landing was the 90s. So I'm hopeful that they can land the plane, but I mean, if the Fed typically overdoes it, and I'm hoping maybe they're a little nervous about that in this case, and we'll get a bit of relief before we fall off the cliff, but remains to be seen.
Yeah, I mean, we've been seeing in the market everyone kind of on hold, waiting for that to happen. So they don't want to make any moves until the rates come down. And frankly, a lot of it's because the prices don't make sense, and sellers don't want to sell at prices that do make sense. So you're seeing transaction volume down anywhere from 50 to 70%. I've heard of brokerage firms in the Tampa Bay market even down 90% last year.
Yeah.
So it's a lot of people kind of sitting and waiting right now. And it's amazing how well everyone's been able to sit and wait. There hasn't really been a lot of pressure to just get money out the door. I think you saw that in the great financial crisis where people were putting money out the door until the fat lady was singing. And now I think we're a little more patient, and there's enough capital out there to be patient and to do so and wait for the market to kind of stabilize a little bit here.
That's interesting because there is a ton of liquidity out there in capital. Most of the capital I feel that's available right now is vulture funds, folks looking to pick up distressed assets. Yeah. And I know you're getting the phone calls. I'm getting the phone calls too. I
just don't know how much they're actually transacting. There's a lot of people knocking on doors, but there's not a lot of distress out there yet. And the stuff that is distressed do you even want to buy that? I heard of a Canadian pension fund transacting on an office building for $1.
Yeah, I saw that one too.
Yeah. So it's where there's distressed, it's very distressed. And where there's, everywhere else, it just doesn't seem like there's enough out there for as much capital as on the sidelines.
Well, you're not really seeing any foreclosures. And I will say maybe in office space and in some assets that were having issues, before the pandemic and now that interest rates and operating expenses are up there. I mean, they were challenged to begin with. But, we're a year removed from Silicon Valley Bank and Signature Bank failing, and we really have had no issues since then. I mean, we did have the issue with New York Community Bank, but that's a little bit of an anomaly too because of their heavy concentration in rent-controlled apartments in New York City. But they got bailed out, so they got a capital infusion. I mean, do you see the big wave impacting regional and community banks that everybody is talking about?
Well, I do believe the whole survive to 25 thing does come into play a little bit with the Fed window closing and banks having another year, basically until March 2025, to figure that component out. The good thing is we're not seeing deposits leave or move like they were last year. The question is, what are banks going to be able to do to kind of shore up their loan to deposit ratios between now and March of next year?
I mean, I largely think, you were talking about, some banks are going to have issues. I largely agree. I mean, there's a handful of banks out there that have capital at 300% of or commercial real estate loans of 300% or more of their capital, and that's problematic. But again, going back to needing to understand what the composition of the portfolio is, like if you're heavy in office, I mean, you're going to have some challenges. If you did a bunch of multifamily lending within the past 3 years or so, 3 to 5 years, your interest rate is up and you're coming into a market that you've not had the rent escalations that you had previously. Mm-hmm. But if you've had loans on the books for a while, and it doesn't matter really what asset class, banks this cycle required equity in the transaction up front. So a lot of these transactions are lower levered. You've had the benefit of amortization. You've had the benefit of rate increases or rental increases over that period of time in virtually every asset class. Mm-hmm. Maybe office is an exception. So if you're not heavy in office and you're not heavy in multifamily construction, I think you weather the storm.
Yeah, I think it's unfair just to make these lists of banks with the highest exposure to commercial real estate. Again, everything's about the nuance. So if you have a high exposure to, single tenant, long-term leased properties that are lowly levered, I don't care if it's 500%, you're probably going to be pretty good. If you have 300% and you're in, multifamily construction and everything's coming due, or you have, a lot of IO, high leverage office, non-recourse, or whatever, right? I mean, you're going to have more issues regardless of
that stuff's going back. Yeah, non-recourse.
Right. Regardless of what you're
handing over the keys.
What your percentages are. So I think it's unfair when the news just puts these lists out. It is interesting to see, but it's also missing a lot of the story.
Well, and individuals too. So when you looked on LinkedIn or Twitter, there's a handful of individuals who they focus on that one thing, 300% of capital for commercial real estate exposure, or the bank AOCI losses. And that's unrealized bond losses in our portfolio, and not an issue unless you need capital.
Unless you need it. Yep.
Yeah. So you need to look at other metrics. You need to look at what their liquidity is. It's not as simple as looking at one thing. You mentioned nuance, and that's absolutely true when it comes to banks, and which is highly complex. And a lot of people don't understand how a bank operates.
Right. And it's, for a news article, it can get kind of boring too, right? So the news wants the nice.
If it bleeds, it reads. You want the headline.
Right.
Oh, yeah. Every bank is going to fail. So what about cap rates? So it's interesting because conceivably the U.S. Treasury rate is up, which is the risk-free rate, which investors you would think would want a higher rate of return. So conceivably that is your cap rate. We've seen cap rates come up a little bit, but there hasn't been a substantial move, especially, you're talking about triple net retail. We've seen some movement there, but largely cap rates haven't moved as dramatically as we thought they would. Values are holding up relatively well. We get appraisals that surprise us all the time because we're thinking, okay, office market is not great. And then we get the cap rate and we're like, well, that's really kind of interesting.
Right. Well, again, if transaction volume is down 50 to 70%, you really don't know where that cap rate is. And so, it's kind of dependent on what the expectation is in the future. So when you do see these appraisals, or you do see the handful of trades that are made, there's an expectation that, rates are going to come down, rents are going to continue to increase. And it's really only in those circumstances where it makes sense. You mentioned the triple net single tenant space. Those margins are so thin that for someone to get it wrong there, you're looking usually for a 3 to 5% return on those. So there's not a lot of room for error unless they're really just trying to avoid the taxes and doing a 1031, which we see all the time as well. Yeah. But if you take a 4 cap and bump it to a 6 cap, you've already lost a third of your value, right? So if you're not seeing that transaction, you're not seeing that potential 30% haircut to the market. So I do think right now we're probably looking at a 20% global probably overestimate of where the values are.
I've heard that number.
Again, a lot of nuance there too, right?
There is, yeah, and I've heard up to 40% in office, which to me that seems very plausible. Right. Just because we don't know where the market is. We had a crazy event in the pandemic, and office was already having some challenges anyway, and that accelerated it. So those leases take time to burn off. I would say interesting though in Tampa, and you already touched on it. We're we're not seeing that. We delivered over 1 million square feet of office. That high-end, highly amenitized space, Jimmy, just got gobbled up virtually overnight.
Yep.
It's good to be in Tampa.
Yeah.
Especially in the office space.
Well, and it was interesting too because back in the great financial crisis, Austin was kind of the haven. And right now in commercial real estate, they are largely overbuilt. They're having a lot of issues in a lot of different product types. And it's actually kind of surprising, but it feels like this time around, it's Tampa, it's Miami.
What do you think about multifamily? So, I mean, I think every product type here, that one is probably the most challenged. And I say that loosely because we've got a 9% vacancy rate. I mean, it's not terrible, but we've had a tremendous amount of inventory. I think 9,500 units delivered within, maybe last year. We got another 14,000 that are coming down the pike, and we were absorbing about half of what we're bringing to market. What's your feel on the multifamily market here?
Yeah, I mean, I would say in general, multifamily is a pretty safe asset in the sense that you always have the agency and HUD that's going to be supportive of it. It is housing, so you're going to always have that kind of low rate, long-term debt available to you. The question is, how much equity do you have to kind of ride this next, I would probably say 2 to 5 year window. We have to recalibrate where we are in the market, between COVID delaying projects, and then all these new projects coming online to follow the flow of people coming to the area. We had a lot get delivered all at once. Now, again, we're not, like I mentioned earlier, we're kind of in the middle of the pack when it comes to, rent growth or rent decrease we're seeing in the market, and vacancy rates. So we're not in, I would say, anywhere near the Nashvilles and again, Austin, of the country where the overdevelopment was too rampant. But again, we're talking really strong too quickly, and now a lot of delivery all at once, a little too quickly. It's just we have to stabilize and get through it. I don't think it's going to be a long-term issue. It's going to be a short-term issue. So it depends on what your relationship is with your bank, your construction lender, and then how much equity you have. We're hearing a lot of equity players, and I say a lot. I mean, the story is out there of the equity players that are just pulling out completely. We have a project downtown that's, as you probably know, a parking garage just sitting there waiting to get completed. But those are going to be kind of the few and far between. So you make sure you're well capitalized. You got to remember a lot of these construction loans were done 50 to 60% loan to cost. So there is a lot of equity still in those deals.
Yeah, and I think what's interesting about some of it's just the timing, right? Interest rates spiked, construction costs haven't come down. So I think to your point, that's a little
rents
more
are plateauing.
Yeah, rents are plateauing.
Insurance is
right. So how do you pro forma that? So for that reason, I mean, if you came out of the ground already, I mean, you're going to have some challenges. There's nothing coming behind it. So I do think, especially if rates stay higher, it's not going to pencil out. So we're also dealing with the issue with the home affordability, and there's no inventory. So those folks that need to create a new household and want to move out, I mean, they're going to be renters. So I think that's good for the multifamily market. But I really think because there's nothing coming behind it in the next couple of years, and by the time everybody mobilizes and maybe in a lower interest rate environment, maybe construction costs have come down a little bit, so these projects make sense. That inventory is going to be gobbled up, and we're going to be back to 10% annual rent increases. Right.
And the insurance companies have short memories too. So you have a couple hurricanes, everyone pulls out, and then a couple years later, they realize what great money they can make in Florida, and they all kind of come back. And you're starting to see some of that. You're starting to see some of the insurance companies coming back. I think, come next year, knock on wood, we don't have any big storms. That whole part of the market may be, figured out too.
No, we've had 7 new insurers come to Florida in the past year. So, and maybe that has something to do with the legislation that put in place. They feel a little more comfortable about the prospects. To your point, maybe we had a couple storms last year. So let's not.
Well, and I think, there's been some good things with the state legislation. I think the Live Local is going to help a lot. From what I'm hearing from everybody, while they are still kind of trying to figure it out, they think it makes sense kind of in the long run once we do kind of figure it out. And just to give you a little feedback on that, it basically allows most developers to get approval for multifamily on commercial zone land, higher density if they add affordable units to their property. But the great thing about it is it's not a restrictive agreement that you're entering into for 30 years, like typical affordable housing, you have to maintain it for 3 years. After that, you can decide to switch back to market rate if you want to. You'll lose those tax abatements for that year, but you're not, restricted. And like we're seeing in New York, a lot of that product is really struggling right now because they're restricted at rates just don't make sense for the cost of the property. So
no, not at all.
It gives a lot of flexibility for the developers. Unfortunate timing that this is coming into play when the market's, kind of halting right now. But I think in the long run, it's going to help. It's going to help with affordability as well.
Well, yeah, I'm a big proponent of just, build, baby, build. We have it's simple supply and demand, right? You bring additional units to market, and the value is going to go down because we're oversupplied. And the pushback I always get from people is like, no developer is going to overbuild. And you're right, but that's how these things work. All these projects come to market like we're seeing now. And you see rents maybe come down or at least stabilize. So I love the Live Local Act because the other issue is politicians want to get reelected. Most of these projects are protested. People don't want it. They love the idea of affordability, love the idea of affordable housing, and everybody needs to live an affordable lifestyle. But I don't want it built next to me.
And density is something people always fight, and it amazes me because density helps with infrastructure. Everyone always says, our infrastructure can't support it. Well, if everyone was dense in a downtown area, they'd be walking and they wouldn't need to, be driving as much, right? So when you have that kind of urban sprawl, it does lead to more, pressures on the roadways. So I like the density component of it as well.
No, and I think it's important. And the Live Local Act took away the ability to bring those things in terms of zoning and local municipality control. And it's a little bit of a conflict because I agree that local municipalities should largely determine their own fate. But what we've seen consistently, at least when it comes to higher density, apartment and affordable living projects, that density gets cut back. So we're not getting the supply that the zoning and land use would allow for in normal circumstances.
It just doesn't make sense. If it doesn't make sense, no one's going to do it.
Yep. If people are investing in this area, I mean, where would you recommend they put their money in, at least in terms of location, in terms of property type? We've already talked a little bit about what's working, what's not. So if you're going to put Rachael Brown money down, where do you put it?
Sure. Well, I think in our markets, you're talking the strongest markets are infill, industrial, and retail. You're seeing a lot of spec industrial that has taken longer to fill up out in the kind of Lakeland, Plant City area. And so that market's a little tougher. You have to be a little more patient, and you have to have a bank that's a little more patient for you to lease that up as well. And
you've really seen that market transition because I won't say a lot of that space has been absorbed, but it's finally starting to be absorbed, and anything new that's coming out of the ground is build-to-suit. I think the spec market for the most part is at least gone temporarily. Would you?
Well, I think there's very few companies that can take a million square feet industrial space, and so we're kind of reaching saturation in terms of who's out there looking for it. And then in terms of, multifamily, you're seeing a lot of the largest vacancy increases are in kind of the Pasco area and then the southeast Hillsborough area, mostly because those were, kind of underserved to begin with. And they were
overbuilt
places that you could get land cheaper. And so a lot of money flew into those areas. But, the Sarasota market's been really, really strong. And then, Pinellas County, just because it's infill, it's hard to overbuild. So there's still a lot of value there.
Yeah, I think the challenge there is though, can you find land? How much does that land cost? But
that's
you're
for everything right now, to be honest. Yeah,
absolutely. Well, and that's why you saw, to your point, developers go to Pasco, go to South Hillsborough County, a little bit out to, the east. The challenge we have there, of course, is we were talking about density. Our transportation infrastructure is not the best, and we can't seem to figure out mass transit. Can't seem to figure out to bring multiple counties together to agree on at least a cohesive transportation plan. So that in itself presents a challenge. Yeah,
it does seem, I don't know if you've noticed, but it seems like every road in Tampa is under construction right now or going through some big expansion. I think there's a lot of tax dollars between the increase in the tax bases and the number of people moving here between the state and local to put attention towards it. We'll see how smartly they do it, but I do think the money is there if we do want to do a lot of transportation upgrades.
Well, and I think we're now actually having a serious conversation about a regional transportation planning organization, which that's it's never been seriously considered. I don't know if we get there or not. I mean, a lot of parochialism and just protectionism that, you know, it's hard to break down those barriers, but we're having the conversation.
Right. And there's a lot of politics around it too that don't,
Tons of politics.
Make smart decisions sometimes.
Now, we haven't really talked a lot about retail. We're not building a lot of retail.
No.
Retail has performed great. I mean, no one's building a mall. No one wants to do that today.
Right.
So we're seeing grocery anchored, but put your money in retail?
Absolutely. Well, I think in kind of contrary to what I mentioned earlier about maybe industrial multifamily, there's a lot of growth, especially to the north of us in through like Citrus County, Hernando County, Pasco, where people are just moving that direction. And so the retailers want to follow. And so we've been seeing a lot of opportunities where, big national chains want to come in and make sure they plant their flag where the population is moving. And that's been a very strong part of our market. There is a little concern on the kind of local tenants. We've been seeing, I think, banks in general just a little more distressed in the SBA side of the business. So then the question is, does that trickle down into some of the kind of infill, older, properties with more local tenants? But at the end of the day, I think retail's been kind of secretly the strongest asset class in the area. And, especially in the Midwest, you can't say that for a lot of different areas that have really been struggling with their retail.
Yeah, and I think overshadowed by the whole, retail apocalypse, which was really kind of a slow moving, but kind of towards that B and C regional malls, not really seen in that local shop space. But you're right.
And again, quality of life issues, right? You got crime and different things going on in some of these markets where big national tenants are just saying, I'd rather leave and keep paying the rent on a dark building than deal with what we're dealing with. And it doesn't seem like that's getting fixed from just purely what I'm hearing from people that are moving down here still, from the DCs, the Phillies, the New Yorks, the Chicagos.
No, they're angry at the retailers for closing, as opposed to putting law and order and not allowing people to shoplift and let them get away with it.
Right.
So good conversation, Rachael. Anything you want to add?
No, I mean, I think a final note is just, great that we are the Bank of Tampa and we're located in the Tampa Bay market. I say yes in my backyard. The more the better.
YIMBY?
I'm a YIMBY. And what I keep hearing from people that have moving down here is that we're so open to sharing and to working together. And what a great real estate market this is, because everybody benefits when we work together. So I'm very glad to be here and be working in this community.
Kumbaya. We are a community that doesn't put out their hand to handshake. We put out our arms to give you a big hug when you come.
Absolutely, or at least a fist pound.
COVID friendly. Yeah. If people want to find you, Rachael, where do you want them to reach out to you?
You can find me at rbrown@bankoftampa.com, or on the Bank of Tampa website. You can also find me on LinkedIn and find podcasts like this one.
Well, Rachael, since you are an employee of the bank, we will definitely have you on again.
Sounds good.
But great job, Rachael. So if you have a future question or a show idea, or would like to become a sponsor, you can send us a message at moneymarket@bankoftampa.com, or find us on LinkedIn, X, Facebook, and on Instagram at Bank of Tampa, or online at bankoftampa.com. Thanks for tuning in. Thanks for subscribing, and we'll see you around in the money market.